Okay. Um, can you see me, hear me? Audio, video, okay? Hey, give me a thumbs up. Yes, no. Am I doing a little dance by myself over here? Can you? Any luck? The video? Right now. Try it again. Any luck this time? Okay. Let me know. I'll refresh on my end if that'll help too. About now. How are we doing now? Will that work? Gonna get this sorted out. Yes, no. Ah, lovely. Now we're in business. Okay. All right. Um, so this, let me start out how we normally start out. So we so these coaching option recordings or sessions are always recorded. So if for whatever reason you are unable to make it or you just want to go back and review, um, feel free to. They are up on the T3 YouTube stream. Typically the following day by the afternoon at the latest. And they're up there. They're at your disposal. If you have any questions about something we went over and you weren't able to make it, please don't hesitate to reach out. So also, I guess I haven't mentioned it in a while, but if you are unable to make it, or you know you're going to be unable to make our next or an upcoming option session, and you want me to go over something, even if you're not there, just shoot me an email, send a message, let me know, and I'll be happy to go over it. When we get together the next time, or even just answer your question as like a, just like a separate email during the week. So Long story short, just don't hesitate to reach out if at any point you have any questions. All right. Also, interestingly, this might be our last meeting on this version of the VTF because I believe, fingers crossed, that the next time we get together will be on the new VTF, which should be kind of cool. Um, it's going to be a little bit different experience. So I think, um, at least from what I hear, we should be. Yeah, so the beginning of August, we should be on the new VTF. So that's definitely something cool to look forward to. Um, so yeah, I mean, this will be the last get together on this version, and then we'll all be on the new version. So it'll be definitely be like a new start. So we got that to look forward to next time too. All right. Um, so let's go. Well, usually I begin with the spiders, but let's go with the Qs because I mean to be honest, the Qs in tech really dictating most of the action right now. And last week I did a video during the middle of the week, kind of talking about how Qs are just basically stuck in this trend, right? And the conversation really started to pick up about whether or not the Qs had topped. Last Monday we had this really nasty green to red reversal candle and just some really sharp bearish reversal patterns that developed in a lot of the tech leaders. And while definitely, I definitely acknowledge that the patterns don't look particularly good. Even a lot of them still don't look good. Um, the truth is that the Qs really never did any serious damage, right? I mean, basically what happened was the Qs started to get extended through the top of this trend channel, and they basically just had a high volume reversal back into it. So they held the 8 EMA, never even got down to the 20. And I guess like what we were talking about earlier, Mercy, is that I mean, it's just so difficult to get a sustained drop in tech. I mean, the leaders continue to lead, and you basically had this really crazy reversal, a few days chopping around, and then what do you know, Qs come storming right back, right? So at the moment, the Qs are getting close to the top of this trend again. So the next point or next couple points on the upside might be a little bit more challenging, just in the sense that it tends to be like the area where we start to run into some supply, right? I mean, it's a very well-defined trend that we've had since the beginning of April. So we extended through the top, reversed right back into it, but now we're getting back close to the top again. So I'd be like a little bit maybe more interested in like trimming some tech gains, especially if stocks are starting to extend a bit, because we are getting to the top of this channel, and it's been a really extraordinarily well-defined steady channel. So kind of have to like keep that in the back of your mind, or at least I am, as some of these tech names start to really start extending and rallying again. So do you want to talk about like the intraday setup or intraday portion, Mercy, or we can skip it too and just spend time going over other things? 'Cause I know we were mentioning like the intraday. Yeah, yeah. So so with 5 minutes, go to this. So this is the 5 minute. These are 5 minutes. This is the bars for today. What do you normally trade on? Like intraday? What's your time frame or time period you use? Yeah. So just tell me 2 5. Okay. So we'll use the 5. If you want to go shorter, let me know. So which was the what at what point was it that you I mean, was it around here? It's like around like 11, 10:30, 11, or was it later in the day? Yeah. I could see it perfectly. Yeah. I can totally understand what your thinking was. Yeah. Because it coincided it coincided basically right with the high from this bounce from last week, right? I mean, I actually I think that probably was a pretty good level to try, because you had like a real sharp move out of the gate, stalled right at the top, right? You started right at the top of like the bounce from last week, and starts to like kind of creep lower. So, I mean, overall, I mean, I actually I think you had the right idea there. Um, maybe like maybe like the problem arose from just letting it get through the top of that and continue to extend. Yeah, at 1225. So, so about here when it looked like you're gonna get a little bit of like another pull. Yeah, yeah, I can see that. I guess the way I would view it intraday is that, or at least what I like to do intraday is I like I can understand like having a position, um, but what I prefer to do though, like after, so if I have like a starter position, then what I like to do is add, more so, like I don't particularly like adding against me like intraday. So, um, you guys didn't tell me my collar was popped up. So I guess I probably would have preferred to either keep, so like short, so like if a stock rallies, right, and you short, and then it keeps rallying and you short more, right, so like that's adding against your position. Some it's some people call it fading, um, but it's kind of like you're adding against it, right, because it's moving against you and you're adding to a position that's moving against you. It's fading, it's cost averaging, yeah. No, I mean, it definitely works for some people. I think that, um, I think it definitely works for people. I mean, I know a lot of traders at T3 have success that way. Um, I think, what's important is to, I think you ultimately do need stops, right? Because you don't want to get to the point where you're just adding and adding and adding and you don't have a stop, right? You basically just keep adding to a trade that's moving against you, right? So no matter what trade you get into, and like this is equities, this is also options. I mean, there's a point where you have an exit, like so. If you say like, okay, like I will start here, and then if it moves against me, I'll add a little bit more, right? But then once it doesn't really start to roll over, I don't want to be a Monday morning quarterback, but I mean, it's basically like once like you add for the second time and it's still not moving in your favor, then it's basically coming to like the point where it's like, okay, where's my stop, So it's not just it's not just keep adding and adding and adding, waiting for it to maybe roll over. It's like, okay, maybe you have like, say, like you'll give yourself like 1 to 2 ads, right? So you have like the position started, maybe you have one more ad, and then maybe you have a stop, right? Or maybe you have starter position, ad, ad, and then you have a stop, so it's ultimately like I don't think like I don't think that you approach the trade necessarily badly. I think what you need is basically just to have like a tighter stop or maybe like a hard stop, and just say like, okay, it's not going to work. I'm just going to take the loss and then move on, especially like if it just began as like a day trade, um, and as the day wore on and it still wasn't reversing, then obviously like your time. Yeah, no, I totally agree. Like it looked like it just kept going and going and going and going. You think eventually it's got to pull back. I totally understand like the logic behind it, but I think I still just think that, like, at the end of the day, just make sure like when you get in the trade, there's like a stop level, just so you don't put yourself in a position where it just keeps moving against you and against you and against you, and you're more like hoping that it comes back. or hoping that it reverses versus actually thinking there's a chance that it's going to, you know? Yeah. Yep. Yeah. No, I totally agree. Um, is it normal? I mean, it's a new normal because prior to maybe like last year, it wasn't necessarily normal. No. So, is it normal for the last 10 years? Not so much. Is it normal for the last year? I guess so, because we've seen it happen all the time, right? So, depends on depends on which normal you're talking about. Yeah. No, I totally understand. And again, I don't want to be like a Monday morning quarterback because I make plenty of mistakes. Um, I think what really helps me. I think what helps me is I set levels that I say so like what it was something I don't even know. So like an Apple, right? You know, like I personally can't believe Apple keeps going up. Like I'll talk about this, but like I personally really can't believe Apple keeps going up day after day after day after day, right? Like I just I don't really understand it, right? But at the same time, just because like I don't know why it keeps going up, like it doesn't necessarily mean that it's a short to me, right? So what I do is like I don't really I don't force my opinion on a stock just because I think Apple should go down doesn't mean it's necessarily short, right? So what I do is like I try to be particular with my pattern. So for Apple, I mean it's very clear that this 8 EMA, right, has just been an unbelievably strong level of support on Apple for months now, several months. So Apple wants to go up, great. Like I'll let Apple keep going up, right? And then what I do is like if it gets down to the 8 EMA, then and it starts to tick below the 8 EMA, then I might think about a short, you know? So it's not as if like my opinion of Apple has changed. Like I'm still interested in going short, but I have to be more selective with my entrances because the chart right now is not telling me to go short. So there'll be short opportunities, right? Like the same with the Qs. Like there'll be plenty of short opportunities, but like you know, maybe like today just wasn't it, right? Maybe it'll be tomorrow, maybe it'll be the day after, right? I mean, but for whatever reason, like the chart today, and like people really wanted to buy the Qs, and the chart after it got to a certain point, it just kept wanting to go and go, right? And there's nothing indicating that it really was going to pull back. So it's like Apple, right? Even though I think Apple is a short, there's really nothing indicating that it's going to pull back. So I need to either hold off and not do anything with it, or and just basically wait for some sort of short setup, right? And to me, like that would be like a break below the 8 EMA, right? So it's not as if my opinion has changed, and I'm just because I don't think it's gonna just because it doesn't stop going up doesn't mean I want to go long. Like I do want to short Apple, but I just have to be very selective in particular with like the setup that I'm waiting for, you know. Especially if I'm using options because yeah, yeah, no, I mean it's very tough to short tech. I mean, it does not stay down long, and it's just it's a very challenging. It's very challenging to be consistently short tech. Very challenging. Yeah, yeah. No, totally understand. Totally get it. Yeah. Well, I mean, I guess what you want to watch now with Qs, it'll be a big week because you have this week you have Microsoft, so definitely one of the heavyweights. Now you really just want to see how it acts as it approaches the top of this trend, right? So I mean it's been a very well defined trend, and right now the top of that would be like up around like 270, give or take, right? So as we kind of get to the top of this channel, this trend, you really want to wait and see how it acts because I mean there is a chance that because it has been well defined and so consistent for the last few months, there is a chance that the Qs start to run into some supply up here, right? And you might get like a short opportunity on the Qs, at least just for like a little bit of retracement off the top of this. So you know, again, it's just it's not as if you can't like it's not as if you need to change your opinion. Like you can be short tech like and make money, but you have to be more selective because obviously like the trend is higher, right? Yeah, yeah. No, I yeah, yep, yep, yeah. Totally get it. Totally understand. I mean, I do a lot of, you know, as much as like I say, like, I yeah. Well, it's okay to have an opinion. It's just it's what gets me into trouble is when I force my opinion on a chart, you know? So it's like I can have a very strong opinion on something, but just because I think something and I want something to work one way, it doesn't mean that it's going to, you know? So it's like I feel like it's always good to have an opinion. Like my biases affect a lot of my trading. So if I'm bullish biased or I'm bearish biased, that's going to affect the way I approach a trade, right? But at the same time, just because I'm bullish biased, it doesn't necessarily mean that it's like the stock is going to go up, right? Or it doesn't necessarily mean that it's like a bullish pattern, right? Like I could be bullish on something, like I could love a company and I could think that it's way undervalued, but just because I think that and I'm bullish on it doesn't necessarily mean it's like a great bull setup, right? Uh, Yeah, I think it's good. Like you have an opinion. You think Qs are overextended, right? But then it comes down to waiting for that pattern to present itself, right? Like a compelling short opportunity. hmm So that's I if I could like really like offer like one piece of advice, it'd be that it's like opinions are good, right? Like opinions are important, but it's also waiting for the chart and like the technicals and maybe the like things to line up with your opinion to really like say like, okay, I'm bearish and this is like a quality bear setup, then that's like a good trade setup, versus like I'm bearish but the chart just keeps going up and up and up and up and up. It has to come down, I mean, like it's just like it's a different way of thinking about it, but I find like it keeps me out of trouble sometimes. hmm yeah. Okay, so today, definitely this this to me was probably the biggest development of the day. Was the SPY, because they have been just absolutely stuck here. So you can see why this is significant on the SPY, and it had been this 322.50 to 323 level had been like a real heavy area of resistance on the spiders, multiple days over the last month. So it was the beginning of June, and then it was basically most of last week we spent kind of hitting it and failing. So um, why it's important is because um, tech has been so significantly outperforming everything else that they've been kind of waiting to see if like the S&P or the Dow or the Russell. Um, I'm leaning more in the camp that this is a breakout because of just how steady the action has been. So I suppose I'm viewing this more as a breakout. Um, I do wish the volume was better today, which was a little bit concerning. So if I had one concern, it would be that the volume kind of stunk today. So you can see down here. So you can see that the volume profile really wasn't anything special. So that was a little concerning. But overall, I mean, it's important because like we need some participation outside of tech for any sort of sustained rally. I mean, or longer term, because tech can't keep going up every single day. I mean, at some point we're going to hit at some point we're going to hit exhaustion, and then you need other things to participate. So S&P, it would be good if this started to make a move, and right now it's starting to break through resistance. Earnings season's probably going to dictate whether this is a breakout or a double top failure, like you said, because I mean, as go earnings, probably so goes the Qs and the S&P. But it's good because a real clean, clear level of resistance, and you can see that there's a real clear gap above to like three, was it 333, 350 area. So you have like a really nice technical setup, and I think people have been watching this because it's a little bit more broad. Well, not a little bit. It's definitely more broad than the Nasdaq because it's a bigger a bigger representation of like all different sectors. So it would be, I think, net positive if this starts to get going, and it could pick up some momentum if it can really start to like climb into like the mid to high 320s because it'll clear like this longer term resistance range, and then you have like this really clear gap, right? Like a real obvious gap from the end of February. So I thought this was like a big development. Well, I mean, there was a lot going on today, but to me, like this was a real big development because, again, Qs have obviously been leading. People have been waiting for other things to participate, and now S&P is really starting to look a lot better. Earnings this week, though, I mean, you have big tech. You have, well, last week we had a lot of banks, but you have healthcare, you have retail, you have industrial. So a lot going to be going on, and the earnings had better be good, or at least not as bad as expected or feared, because um, I think Netflix. Yeah, I think I think only if one is particularly bad, it could hurt sentiment, but I think it would need to be like multiple for it to really impact the entire market. So if like for instance, so say like Apple is lays an egg, and it's just pretty bad, and Apple gets hit. I don't think that in and of itself would hurt the whole market. But say Microsoft is surprisingly bad and Apple is surprisingly bad, then I think that could really start to weigh because they're huge companies, and they've done a lot of the heavy lifting. So if you start to lose those, then I do think it could impact the entire market. But if it's just like one of them, then people might, I don't want to say dismiss it, but they might not, they might not be so worried. Like Netflix wasn't particularly bad. It just wasn't as good as expectations had gone. I mean, people kept raising their price targets, and they kept raising their estimates, and the stock kept running, and then more people raised their price targets, and more people raised their estimates, and it kept going higher and higher and higher. So, I mean, the truth of it is that like had people just kept their estimates where they were originally, the stock actually would have beat, right? Yeah, yeah. Well, that's a huge thing to factor in around earnings. Is our expectations just too high? And I do think, which we'll talk about today, is that I do think that for a lot of tech stocks, the expectations are ridiculously ridiculously high, like almost to the point where it seems that they're just set up for missing because it's just they're almost like unattainably high. I feel like. So we'll see. But Netflix is kind of what I mean by that. Is that people kept taking their price targets up, kept raising estimates, and kept going and going and going, and created this cycle and great run in the stock. Right? You had it was like one after the other. Netflix, like people would. What is this? I need to refresh this. Right. So it's like raise the estimates, raise the target, stock goes up. Raise the estimates, raise the target, stock goes up. Raise the estimates, raise the target, the stock rips, right? And then the problem is that the expectations have gotten too high, and then they report and they miss the high expectations, and the stock comes back down. But um, like it's something that I feel like you really need to like factor in as we get into earnings season is where are the expectations, right? Like has the stock been absolutely parabolic into earnings, like Amazon, right? And is it just too high to really capitalize. Like, is there going to be trade potential when every single person is expecting like a monster number, whether it's justifiable or not, right? Yeah. I think Apple is probably in a camp of, yeah, I mean, after the run it's had, and people kept raising targets. Um, it's just, like you kind of have to be more cautious, I think, on some of these stocks that have just had huge moves. So whether it's earnings or estimates are too high or option pricing is too high, because that's definitely another big thing to weigh when you're trading earnings, right? Is our option pricing, it does option pricing leave room, right? And on some of these, I mean, they just might not. I mean, it just might be price per perfection, both fundamentally and option wise. But we'll see. Um, let me refresh this. Just give me a sec. It was running slow, so I wanted to refresh it. Um, so gold and silver, right? Like I like talking about these. They're acting just fantastic. Just great steady action. They're not flying higher, which is also kind of good because it makes it a little bit easier to hold, in my opinion. But I mean, gold, I really feel just, you had like a nice little bull flag, right? Broke through the bull flag. Now it's starting to move higher. Silver is definitely not as tight, but it's also arguably more explosive, because what you'll see about silver, just move these bars up, right, is that, interestingly, silver put in a new 52-week high today, okay? So I always like to do this to just kind of remind, kind of take the longer term perspective of silver, but this is why it's important. I mean, look at the yearly chart of silver, right? It's breaking out of a really long stretch of poor performance. So when momentum is high, to me, silver seems like it has a ton of upside potential because it's been so out of play for so long. It's been performing so poorly for so long. So it's not as tight and it's not as steady as gold, but it also has more explosive potential. So I like the way gold is acting. I like the way silver is acting. Um, I'm not trading SIL. I don't have SIL, but we were talking about last time, Mercy. I mean, look at the chart of SIL. It's acting unbelievable. I mean, just that's the weekly chart, but like the daily chart, I mean, just higher highs consistently. It broke out, right? So SIL, let's move these up. So SIL had a breakout, right? Higher consolidation, held the ADMA perfectly, and continues to extend, right? GDX, same idea. GDX, just new high consolidation, held the ADMA perfectly, extending higher, right? Yeah. So they're not as volatile or sexy maybe as the some of these momentum tech stocks, but I think like under the radar, the action is absolutely fantastic in gold and silver and the miners. So from like a swing trade perspective, I just feel like we just let them do their thing, just manage them, right? Like we still have like 1 to 2 months on some of these swing trades. So, they're acting great. They look great. We have time, so I'm just letting them develop. So if you don't get like updates every day on them, it's not because I'm not paying attention to it. It's really just because there's really not a whole lot to do. I mean, I'm letting them play out, right? Yeah, and they're good they are kind of like they're a hedge of sorts, in the sense that like they're not going to be like a perfect inverse correlation to like a portfolio of your stocks, but they're a good hedge in the sense that they are more defensive. So if people get a little bit more nervous, it could be an area where people put money to work, right? If people want to take money off of tech because they think it's extended and they're worried about a possible pullback in the market, it could be an area that catches some buying demand, right? Because it's kind of like a more pseudo defensive type area. So it's not going to hedge. It's not going to be a great hedge for like a portfolio of stocks, but it could be a good hedge in the sense that it's more defensive, right? Like people might put money into it if they're starting to get a little bit more nervous about um, like stocks going forward. So yeah, I mean, like the option positions are acting great. So I'm just gonna let them keep doing their thing. I mean, long story short, um, TLT. So this will be the last thing we talk about, and then we'll get into other things. But TLT, uh, again, kind of the same idea. It's not a perfect hedge, but if people are starting to get a little bit more nervous, could see like the bonds start to tick up. And what's interesting about TLT is that it's actually under the radar, acting pretty strong, pretty bullish, right? Because it broke out. Move this up. So it broke through some resistance, right? Had a little break of resistance, and now it's flagging above the 8 EMA, riding the moving average higher. Basically, you're thinking if it clears like 168.50, 169, there could be a path into the low 70s. So still kind of under the radar, like gold, like silver, under the radar strength in some kind of like defensive oriented areas. So kind of another aim, just letting it do its thing, showing bullish signs. Like it's not flying higher, but it's also working pretty steadily. So just letting it do its thing. I mean that's really kind of what you want. I mean like I feel like it's nice when things work immediately, but I also don't mind when things are slow and steady because it makes it easier to hold. Um, maybe, maybe, maybe it shows people are a little bit more getting increasingly more nervous, or maybe increasingly more um, cautious. It doesn't necessarily mean that we're going to fall apart because we have had bonds rally when stocks have rallied, right? Like look at, I mean, January bonds were rallying. In February, so in January and February, the market was flying higher and bonds were rallying too. So um, it's not like an either or. I mean, they can both rally at the same time, right? Um, but if you start to see bonds really act strong, then it could signal some trouble. Yeah, yeah. Okay. Um, So let's talk about earnings. I mean, I was kind of like going on about it, but um, I like to me like the main question is whether we are just pulling forward gains in tech. So if I know Mercy, I know you're on the VTF, and for those of you that are on the VTF, you probably heard me talk about it, but I just like I I don't like when stocks have huge moves right into earnings because it makes me think that expectations and pricing is and option action is priced in. Like so, like what Netflix did, it made me think that everybody was expecting a blowout number or everybody was expecting good numbers. So when I see stocks just continually rallying day after day after day, it really makes me more cautious from trade perspectives. Like I don't mind trading them ahead of earnings. It's just specifically for an earnings trade, it makes me more cautious because I really have a hard time quantifying like how high expectations are and what's priced in, right? Yeah. So so something like that with like your Amazon, like that's really going to be something you have to be like acutely aware of this quarter with a lot of the stocks is like, is this stock had just a crazy rally and our expectations just too high, right? Because like when it comes down to it, I, I I don't necessarily care if a company beats or misses. I mean, there'll be some cases where I'm only bullish or only bearish. Like I will bet on a direction sometimes. So like sometimes like I'll buy calls, call spreads, put spreads right. But a lot of the time, like what I do and where I find success around earnings season is finding the patterns where I feel like the stock is could have a materially larger move than what the options are pricing in, right? Because like I'm basically viewing the stock set up more against what the options are pricing and not whether I think it's going to beat the expectations from the analysts, like the earnings and revenues. Like that's secondary to me. Like I don't care necessarily that much about whether they're going to beat earnings or miss earnings. Like that's not as important to me as whether the stock looks like it could move more than what the options are pricing in or less, right? Because that at the end of the day is what's going to matter for whether or not I make money or not, is whether the stock moves more than what the options are pricing in, because I'm laying out money on the options market, so that's what's important, right? So when I can't get like a reasonable idea of where expectations are and how much the stock is going to move, because it seems like everything is priced in, then unfortunately like a lot of options are just going to look really expensive, right? So like that's why for like Netflix, like that's why I wanted to make sure we closed the trade prior to earnings, because as it kept running and running and running, like I felt like good expectations and good numbers were starting to get priced in. It seemed like as it kept moving higher, expectations kept getting higher, and the probability that everybody was expecting a beat kept getting higher, right? So that's why like what I find is working right now is getting into these stock trades or positions, these strategies, like a week to like a week and a half out from the earnings date, because that seems to be the real sweet spot window when stocks start to like get attention from traders, start to wake up and maybe start to like put together those rallies ahead of earnings, right? Like that's definitely something that I've been noticing. I feel like it's been working for us, right? Like you maybe be noticing that too, that it's like a week, say like 3 to 7 days out. That really seems to be like the sweet spot when earnings, when people really start to get interested in like a company that's about to report. And that's when you see the traders start to position. And that's when you see the options start to pick up action, right? So, like also that's when analysts maybe start to weigh in, like a week ahead of earnings. They start to say like, oh, we reiterate a buy, we raise our targets, blah 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 blah. So, so like that's why a lot of the trade ideas, earnings related, have been in anticipation of the report. So like what I call those rampant to the report style trades, because I'm seeing a lot more opportunity in stocks that maybe have bullish patterns and and really seem like they could take off ahead of earnings versus specifically like to hold into earnings. All right. So if it keeps working, then that's really what I'm going to keep focusing on, because at the end of the day, all we really want to do is make money, right? Like like I don't care if like the earnings trade plays out the day before earnings or the day after they report, right? Like so if I have to hold through earnings to make money, then that's fine, as long as it's a quality setup. But if we can make money without having to take the earnings risk, then that's arguably even better, because then you don't have the same degree of risk that you would taking something into an earnings report, right? Not all. I mean, in some instances, like I'll keep some, right? So you could keep like a third of position, you keep a half position, you keep a quarter of position. I mean, that's what I did with UNH. I wish I wish I had sold out of it, but um, I had some options that I got into just from like a for my own trading, and got into UNH looking for like a rally into earnings, and it had like a nice move, and I probably should have sold all of it. Well, actually, not probably. I definitely should have sold all of it, but I didn't. I sold half, locked in some money, and then the other half I took a hit on because the stock didn't break out. But at the end of the day, then at least I was reducing my risk by selling 50% ahead of earnings, right? Because it had moved in my favor. It had a gain on it. Not You don't necessarily get more profit, because sometimes you get an earnings move, and like say Twilio for instance, right? So so let's go back to last quarter, right? Like Twilio, software stocks were ripping, right? And like had you had the like the interest in Twilio, then you could have bought, and it had like basically like a 15-point move the 3 days into earnings, right? Now, that's a huge move, especially for Twilio, because 15 to 20 points is close to like what the top of it normally does on these like rallies, right? Like you have like low 70s to like low 90s, so about 20 points. So it had a huge move right into earnings, right? But then earnings were ridiculously good and it had a massive move higher. So it's not always about selling everything. Like you can still keep some because earnings have the opportunities to maybe have like these monster moves that turn like an option trade into a home run, you know? So I wouldn't say that you necessarily get more profit by trading ahead of earnings, but you also don't have as much you don't have like the same degree of risk, right? Because say you had held say you would only put like a Twilio trade in for earnings and you were thinking like, say you were thinking long and ended up missing, the stock dropped 20 points, then your degree of risk is quite a bit higher, because you have that overnight risk. Like Twilio could have a significant gap, but if you are just kind of like trading pre-earnings, like the degree of, like you don't reasonably expect to see like a 20 to 30% gap in the stock overnight if there's no news, right? So I'd say like overall, like I feel like the risk level is lower, but also your profit potential is probably also a little bit lower. Earnings, higher risk, but also higher potential reward because you see some of like those really crazy moves, right? So it's just, to me, like it comes down to like recognizing what the market is giving and just responding to that, right? So right now the market seems to be giving a lot of trades like the 3 to 7 days prior to earnings. So a lot of the option strategies that have revolved around earnings have been in that window of time because that seems to be what what is working best right now, right? Yeah. Okay. Well, I'll talk about calendars and I'll go over like some of like the patterns where I like to do them. But generally speaking, like a calendar for me would be interesting in for a stock in a trend. Okay, so and it really comes down to selecting the right stock, but what I find is that trends basically lead to overall lower volatility, right? So I'll use Apple as an example. I don't know how earnings are going to work out, but so you look at Apple, right? I mean, the stock has just been in a very, very steady trend, right? And what happens in like a trend is that the overall level of volatility on a stock is typically lower because, right, because it's basically just been in this really consistent range. I mean, you have like this really consistent channel. So it never extends too far up, it never drops too far down. It's just basically steady eddy, right? I mean, just kind of riding the trend higher. So a hallmark of a trend is essentially lower volatility and tighter trading ranges because it never really gets too high and it never really gets too low, right? So the overall level of volatility is generally smaller. Now, why that's interesting from like a calendar perspective is because a calendar it's you design a calendar spread, and I'll talk about this in a second, but you design a calendar spread basically thinking that near term stock is not likely to have as big of a move versus longer term I'm expecting a bigger move, right? So when a stock is in a trend, it's kind of easy to have that foresight, right? Like I can say like Apple maybe over the next week probably not going to do a whole lot. I mean, pretend earnings aren't next week, right? So over the next week, Apple probably not going to do a whole lot, right? Because it's in a real steady trend. So it's probably not going to get above. It's probably not going to get above like 405. It's probably not going to drop below 380, right? Because it's just basically been in this really consistent, steady trend. So a calendar saying like maybe you sell next week's 405 and maybe you buy like 3 weeks out 405, right? Because odds are if Apple follows the trend, then it's probably not going to have a huge move by next week because it hasn't really had a huge move in months. But there's a good chance that 3 weeks from now, if it keeps riding this trend higher, that it's going to be above 4 or 5, right? So that's why, to me, like really, really consistent trending stocks are great for calendar strategies because you have like a clear path to visibility saying like this stock looks like it's going to continue going higher, right? But it's probably not going to have a big move in the near term. Um, Over a longer term, it does seem like it can keep going, right? So that's why I think if you're looking at calendar spreads, like a real consistent trending name is definitely something that you should probably focus on because to me, like those have like greater visibility for consistent moves higher, but not a lot of like real near-term acceleration. All right, you kind of see what I mean by that? I mean, so I was looking at this one tonight, but so CDNS, right? Like I didn't. Yeah, it could, and I mean that's always a risk, right? That it has. There's always a risk that the stock breaks the trend, and then it has like a big move higher or a big move lower. But there's always there's always a risk with every trade you put on, right? I mean, any trade, every single trade has some sort of risk associated with. Like the risk with like a trending stock is that it breaks the trend. Risk with a consolidation is that a stock breaks out or breaks down, right? So there's risks associated with every pattern. It's just for a trend, the risk is that it breaks the trend, right? But this is a stock that reported tonight, and kind of like the same idea, right? It's just in a really consistent trend. So you basically it seems like there's a path for it to continue to work higher, but it's probably not going to have like a huge move in the near term, right? Yeah. Yeah, so well, a little bit different, but kind of like the same idea. Yeah, I mean, Netflix is a little bit more of like a boom and bust, where it had like a ridiculously large move, expectations got super super high, option pricing got high, and then it just kind of came back down. So it's a little bit different, but kind of like the same idea, but just a little bit more exaggerated. How about that? I think it's a good way to describe it. Similar idea, just more exaggerated, like higher and then back down. All right. So before we get into like calendars, just so if you're looking for like what I call those ramp into the report style trades ahead of earnings, like 3 to 7 days out, like this, like the main three things that I'm really screening for that I want to see for those patterns. So like if you're looking for other things on your own, what I want to see is first strong recent history of earnings. So like 2 to 3 quarters of solid reports, right? So like that's definitely one of the things I want to see. It's like consistently good earnings like the last 2 to 3 quarters. All right. Second thing is a strong overall chart. So like a decent bullish pattern on the technical setup. All right. Like so that's the second thing. And then the third is kind of a strong sector. So I want to see the sector acting good or maybe a strong overall market if it's something a little bit more if it's something a little bit more like broad or bigger, then I want to see the market acting good overall. So like those are really like my three criteria for those ramp into the report style trades. It's strong recent history of earnings, so like 2 to 3 quarters out, strong overall chart, like a decent like bull setup. So like whether that's like a bullish flag, a breakout, bullish trend, etc. And then I want it to be in like a either like a strong sector or like a strong overall market, right? So like if it's like within tech and tech continues to act strong, like then that to me qualifies, right? Or if it's in software and software acts strong, then that qualifies. All right. And again, the time frame is like 3 to 7 days out. I find like that's right now. That's like kind of like the sweet spot window for these type of trades. So that's kind of what I'll be focused on is like that window and those candidates. All right. Any questions there? Cool. All right. So this is what I started to get into it a little bit. So I'll we'll go through the beginning faster because I feel like you guys might be familiar with like the basics of it. I have talked the basics before in the past, but um, so just very briefly go over it again. But Um, option spreads are either like one of two things. They're either vertical or horizontal. Okay, so this is just like kind of like options 101. A vertical spread is like your normal spread. All right, so that's your standard call spread, standard put spread, and that's you buy, say you buy one 200 strike call and you sell a 210 strike call, right? To like open up like your call spread. So it's called vertical because the strikes are higher or lower than one another, right? So it's same expiration, but just different strike prices. So that's what's considered a vertical spread. Horizontal spread is difference in expiration. So a difference in the time, right? So the strike prices are typically the same, but the expirations are different. So it's not it's across like a different it's across a different time period. So, hence the calendar idea, right? So that's why horizontal spreads are called calendar spreads because it's across a different time period. Not it's not different strikes, it's different expirations. All right. So if you're wondering why it was called that, that's the reason why. Um, and again, just very basic. Like it's you purchase say one call that expires this week, and you sell one call, same strike that expires 2 weeks from now or 3 weeks from now. So your difference isn't the strike prices. Your difference is the expiration dates. So that's the difference between vertical and horizontal. All right, it's very like option kind of 101 type thing. Um, and the reason why the reason why calendar spreads are interesting and why we do them is because it's they're designed to take advantage of implied volatility and option pricing mostly, right? And again, like what we were talking about a few minutes ago, um, you normally want for a calendar spread to work, you normally want a stock to move less in the near term and more in the longer term. So over the course of the expiration of that contract that you're long. So too sharp of a move, like so too big of a rally if you're in a calendar call spreads, or too big of a drop going the opposite way against you is going to hurt because you basically need the stock to do very little or only a little bit in the near term and continue on that path in the longer term. So you basically it's kind of like a fine dance where you don't want it to move a whole lot, but then you want it to move a lot in like 2 weeks from now or 3 weeks from now or a month from now, right? So it's kind of like a weird dynamic that I find I play at with myself where it's like almost like I don't want it to move, but then all of a sudden, like once my contract expires, like the short contract, well, I just want it to go crazy, right? Now, um, also, you don't necessarily need the the stock to do anything to benefit. I mean, if there's a change in the implied volatility of the options, that in and of itself could really alter or change the pricing of those calendar spreads, right? So if the implied volatility of the short-term contracts or say the implied volatility of the long-term contracts gets jacked up a lot because say the company confirmed an earnings date unexpectedly, then the long-term options are going to appreciate in value even if the stock doesn't do anything. So It's either you're looking to benefit from movement in the stock over like certain periods, right? Or you're looking to benefit from changes in implied volatility of different expirations. All right. So this is what I was getting at. Now, um, tr- there's there's a few instances where I like calendar spreads, and trending patterns are definitely probably the top of that list. And it's mostly because of what we were going over. It's like really like the defining characteristic of a trend is that it's steady, consistent, easily kind of forecastable price action, right? I mean, the stock is in a very well defined channel. It continually makes higher highs, continually makes lower highs, right? So you have like this ability to see like this path forward, right? Like you see that, maybe over the next week, it's probably not going to go over this level, probably not going to drop under this level, but over the next 2 to 3 weeks, there's a good chance that it continues on its trajectory higher, right? Because it's in a very, very steady, consistent trend. And on a day to day basis, the overall volatility is typically lower, right? Because you don't have a real acceleration higher, you don't have a real acceleration lower. So it's lower volatility, but steady, consistent price action, right? And that to me is a great recipe for a calendar spread. So like right now, I'm talking about on the bull side because you're seeing a lot more of these on the bull side, but the same idea applies to bearish trends, right? Stocks that are in like bearish downward trends. It's the same idea. Consolidations are also interesting for calendar spreads, but there's kind of like a different element of risk with them, right? So when you're long options and a stock is consolidating, it's not pleasant, right? I mean, if you're if you're sitting in call contracts and you're waiting for a stock to break out and it just continually does not break out, then odds are you're probably losing money, right? Like you're losing premium because you're losing like the time value is eroding. Maybe the implied volatility is eroding because the stock isn't going anywhere. So it's a nightmare, right? Like it stinks being long options when a stock is stuck in a really tight consolidation. But on the other hand, it's great being long options when a stock resolves the consolidation because you typically get a fast move out of the consolidation, like a pent-up move, right? So whether it's like a breakout or a breakdown, so you get a movement in the delta of the options, right? And because the stock is starting to expand its trading ranges and the volume profile is starting to increase, you also typically get an implied volatility expansion. So it's like a 2 for 1, right? You get a movement in delta, and you also get a movement in implied volatility. So what's great is if you can, again, I mean it's a little bit tricky, but if you can design calendar spreads where you're, if you know that a stock is in a consolidation, or if you know that a stock has a major catalyst coming up and it's stuck in a consolidation and it's probably not likely to move until that catalyst, then it's kind of the same idea, right? You say that like stock is stuck in this really tight consolidation. It's probably not going anywhere until it has some sort of news, and there's news 2 weeks out, 3 weeks out, right? So with earnings around, if there's a stock stuck in a consolidation, you could say like maybe I want to sell this week's options because it's not likely to move much, and maybe I got buy options out through earnings because it's likely to move a lot more during earnings, or there's a chance that it could move a lot more during earnings, right? So kind of the same idea, but execution's a little bit different. All right. So again, I mean, I was talking about this as we were going, but these are like the three things that I really, these are like kind of like my three criteria. So it's steady trending stocks, right? Like those I feel like can present great opportunities for calendar spreads, right? So one-sided expectations, clear consistent action, and you get the higher near-term implied volatility, but also lower expectations for overall movement, all right? Same idea, consolidating stock with no near-term catalyst, right? So you're not expecting a very big move to break the consolidation in the near term because there's not really any major catalyst. But there's probably a higher probability that it moves 2 weeks from now, 3 weeks from now, 2 months from now, right? Especially if there's like an earnings or event out on the horizon there, right? So that's another pattern where you could screen that could work well for a calendar idea. Also, what we saw in March, all right. So we actually had a few calendar spread ideas back in March, in February, or I don't know if it was February, but March definitely when the market was really getting hit very hard, and overall market implied volatility was extremely high, right? And the rationale or the reason behind that is like extremely elevated levels of volatility are typically fleeting. We get like those massive spikes in like in really high volatility, and they tend to be short lived, right? Like it tends to come back down, or stocks tend to become less volatile. Stocks tend to consolidate. So that's why when you have like those massive spikes in implied volatility in the short term, like the shorter term contracts tend to be very expensive versus the longer term contracts. So that's why in March we had a lot of the calendar ideas because the short term contracts had just gotten so significantly more expensive from a pricing perspective versus like 1 month out, 2 months out, even 3 months out. So with in those scenarios, we were selling shorter term and buying like a month out or buying 2 months out, just because the high, really significantly exaggerated levels of implied volatility probably weren't going to last for too long, right? So that would be like the third scenario where I look for calendar spreads. All right. Any questions there? But again, I mean, it's definitely something that it, it's not the first strategy that I go to, and I don't use it every single day or every single week. Um, but it is something that's definitely going to be more relevant. I think this earnings season, Microsoft. Let's go back. Um, I mean, I actually, it's actually not a bad idea. I was actually thinking about that, because it kind of does meet like it does meet the criteria of it because it's in a pretty well defined trend. Expectations are pretty one sided, right? And it's had a pretty consistent history of good numbers the last few quarters. So, like to me, like it does kind of fall into like that camp of something that could work well for a calendar spread. Actually, I was kind of like entertaining the idea myself. So I guess like the way, so the main thing with a calendar spread is that you kind of don't want the stock to move through the strike, right? Because that starts to negate the benefit of the strategy. So what I like to do is I like it to be a little bit out of the money, but not too far out of the money. All right. So it's like I don't like at the money contracts, and I don't like far out of the money. It's kind of like mid range. So like I like things that are like a little bit or like marginally out of the money. Is typically like how I like to do calendar spreads. So I don't really like at the money because that to me is a little bit too risky because if the stock has just a little bit of a move, then it could start to negate the whole benefit of the calendar idea. And if it's too far out of the money and the stock does end up pulling back a bit, then that could kind of negate the whole idea because both options might take like a pretty big hit too, right? So the long and the short. So I like things that are maybe a little bit like a marginally out of the money, where they're it's you still need a move to get into the strike level, but they're not so far out of the money that you need a huge move to get there after, right? So for Microsoft, I guess the stock is at a 211, say 211 and 212. Maybe I might be looking at something maybe in like the 217 area. I mean, it depends on where because like 217 was the high from last week, or maybe like 216, 217. So it was the high from last week. Um, I guess I'd say like Microsoft probably I'd be expecting good numbers, but with everybody looking for a good print, maybe it doesn't blow through the high again. So it could take a while to like take out the high. Um, yeah. So I don't I wanted I don't want the stock to get to that strike after earnings, or I don't want it to get through it. So I want it to get close to it, but not through it. Okay, so that's how I would describe it. I want it to get close to it, but not through. Yeah. So I don't want right at the money because that to me has a higher degree of risk that it just blows right through the strike. And I don't want very, very far out of the money because there's a chance that even after even after earnings, like it's still just too far out of the money to ever possibly get there, right? So I want something that is a little bit out of the money, but also there's a chance that the stock could get into the vicinity. Right? So for Microsoft, I'd say like you're looking at the stock chart and saying like 216.50, 217 was the high from last week. So it's a little bit out of the money, but it's it's also still requires about like a 5 to 6 point move. So it's still kind of like a pretty substantial move, but it's also has like I feel like the stock could potentially have a path there, right? Yeah, I know. Again, I mean, like there's risks associated with every trade. I mean, like that's like what you're weighing is like is it going to break the trend, right? I mean, Microsoft has been in a pretty consistent trend, right? So like it's just it's risk to reward. I mean, it's expectations versus stock performance, expectations versus option pricing, right? So like there's no guarantee. I mean, like no trade is like a guaranteed slam dunk. I mean, like there's risks associated with everything. So like these are the things that I weigh when I'm deciding what type of trade I want to put on, right? Or if I want to put a trade on at all. But again, I mean, like that's why I screen for certain patterns because I feel like they have for calendar spreads. I mean, like that's why I screen for certain things because I feel like it gives me a higher degree of confidence that that type of strategy could work, right? Yeah. Yep. Yeah. So it's trial and error, like risk reward. I mean, options are always that's what it comes down to. It's like I can control my risk. What's my reward, right? And is it worth it? Like if I know I have to risk like $2 for the options, and I could only potentially see myself making like $1, is it worth it, right? Or the stock has had, Amazon, the stock has had a uh, nine what the stock has had a 900 point move since it last reported, and the options are pricing in 300 points for earnings. Is it worth laying out the money, or are expectations and option pricing just too high, right? So risk to reward, like is the risk of laying out the money worth potential reward, right? So I feel like these are always things you really kind of have to weigh, and if you just wait for like the right setup, then sometimes you'll just have higher confidence that it is worth it, all right? Or if the risk profile is low enough that the reward is better, then maybe it's worth it, right? So it's just these are like the things you kind of just need to weigh when you're deciding whether to put like an earnings trade on. But generally speaking, Like those are what I'm looking for like calendar ideas. All right. Any questions? And that was most what I wanted to go over. So if there's anything you want to cover or you're exhausted, how you feeling? Okay. Um, well, I mean, we could wrap it up there then. I will. It's gonna be a long earnings on the radar video this Friday because there's a lot next week. I'm gonna try to be pretty in depth with the earnings on the radar video like this week, next week, just because there is a lot of earnings coming up, and we're not gonna have. I'm not gonna have trades on all of them. So I just want to like kind of give you guys my 2 cents on what I'm seeing with them. So. Um, yeah, definitely. I mean, I think earnings are going to be significant drivers of action the next 2 weeks. So if the big tech numbers aren't good, then I do think there's a chance that we roll over. Yeah. So I think Microsoft, Apple, Amazon, Google, Facebook. I mean, they're going to have a disproportionately large impact on what Nasdaq does the next 2 weeks because they're. I mean, those five stocks are worth I think like 42% of the weighting of Nasdaq. So as they go, so goes tech. So yeah, I mean, it's gonna have like a significant impact if they're bad. I mean, if they're good too. I mean, same idea. Okay. All right. So then I guess we'll wrap it up there. Uh, if you have any questions, I mean, I know Marcia, we talked during the day, but if you have any questions about anything unrelated, we want to like bounce an idea off, like please don't hesitate to shoot me an email, reach out. Happy to help whichever way I can. And yeah, I mean, let's hope for some good trading this week, some good action, some good earnings. Just it's earnings season. I mean, this is like the best time of the year every 3 months. So really looking forward to it, and yeah, just hoping for some great trading so we can capitalize on some numbers coming up here. All right. So again, have a great night. Stay well. Don't hesitate to reach out if you have anything that comes to mind. Any questions? Have a have a wonderful week, and I will talk to you guys soon. All right. See ya. Take care. Have a good night.